All right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Axel. Axel is a Boston real estate investor, founded Align Real Estate Partners in college. His firm oversees 450 plus units and $60 million in transactions. He's also co-founded Blue Door Living, managing 700 plus units, and hosts the Multifamily Wealth Podcast. Axel, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, sure. I'll the high level. So I've been in real estate since 2017. I've gone into it buying small multifamily properties, using a lot of private lending and private financing at the time. And this was back when I was coming out of, well, it was my senior year in college and then coming out of college. So, at the time I got my license, was selling some single family homes, was buying small multifamily, 2 to 4 unit multifamily properties throughout New Hampshire. Did that until 2020 or so. Grew a portfolio of 50, 60 units at the time. That was kind of my income, and basically hit a point to where I'd replaced my income with rental properties, and I had to sit back and figure out what I really wanted to do next. Which at the time, basically, I realized it wasn't continuing down the road of buying a lot of these smaller deals, and I had a desire to actually build a real estate business and start buying larger properties. Maybe raising investor capital to do so as well. So 2020, 2021, started learning about the whole process of raising investor capital, equity capital. Everything I'd done up to that point was my own money, no partners, all just private lending. And in 21 and 22, started raising some money on a very small scale to buy, I guess I'll define it as mid-size apartment buildings, deals that were 15 to 45, 50 units in size. And that was going well. We got into some projects both in our local market and some out-of-state markets that we sourced and operated. Did very well, and really in the last couple of years, since mid-2022 up until now, mid-24, we've really pivoted the business into, we're raising capital to go out there and buy small to mid-sized multifamily. I personally live in Boston. The vast majority, 90% plus of our deals that we do are in southern New Hampshire, so about an hour north of Boston for those that aren't from New England. And we really built our business, as an aside, I kind of forgot to touch on this, on going direct to seller to owners. And the vast majority of deals that we do were sourced through cold email, cold calling, cold texting, or direct mail. And then we package these deals up and raise capital from investors to fund them. Also along the way, we started a property management company up in New Hampshire as well. We manage our own portfolio as well as some third party. It's called Blue Door Living, as you mentioned in the intro there. And and then host the Multifamily Wealth Podcast. Been doing that for almost 5 years now, and talk multifamily twice a week. Very, very straightforward as it relates to what we're doing on that show. But that's the high level. That's the spark notes.
I like it. Let's start. Let's try to unpack this. What got you into getting into real estate and from the beginning?
Always been pretty entrepreneurial. So I've never really had a job. I worked at a grocery store for a little bit in high school, but that was like that was my only real job. Before I got into real estate, I had a business flipping cars, just buying used cars on Craigslist, buying and selling cars. So I got into real estate, at an early age, but I still had a couple bucks in the bank, just from that venture, doing that throughout high school and throughout college. And, the reason I wanted to get into real estate was actually I wanted to flip houses. I think the logical graduation from flipping cars, I was like, all right, let's go flip something that's a little bit more expensive, which to me was houses. And I, saw all the HGTV shows. I think that's what kind of got me hooked initially. But as I started learning about flipping houses, I realized that was a very intensive business to oversee and run. I'm not a construction guy. I have no desire to be a construction guy. I think my skills were a little bit more applicable on the sales and the marketing side as it relates to finding deals, raising money later. That's what I found out, or what I later realized I was decent at. And very much like the idea of building a portfolio that pays you even when you're not working, right? Just the whole idea of passive income, I think back in 2016, 2017 was what really caught my eye and started to bring me into real estate. Knowing that all the work that I'm doing will pay me in perpetuity, not just, one time, right? Yeah. And I think that's what got me into the game. And then I realized I like that, I enjoy finding deals. I enjoy, the pursuit of finding a discounted deal, whether it's multifamily, whether it's something else. And then I think we all realize once you're in something for a while, it's it's hard to switch, So I think I've been in real estate for so long right now, or at this point, 8 years, that it doesn't really make sense to do anything else. And I do enjoy the day to day, but that's what got me into it to begin with.
Yeah, no, and it takes a long time to build your real estate business up to where it's an actual business too. So once it starts growing legs and momentum, there's no sense in even stopping. Just keep on creating new problems.
Mm-hmm.
On the when you're going after direct to seller, what got you the training? How did you start? How did you venture down that journey?
I honestly think it was just Bigger Pockets was like the new website at the time. Now Bigger Pockets is just a cesspool of of sales and marketing. It's a very different resource than it was back in 2016, 2017, where it was like a new website almost. But there was all kinds of people on there talking about how they were finding deals outside of just going on the MLS. And the one thing I realized very early on was the deal is the most important part of the equation. Without a great deal, you're not in a position to scale quickly at all, which was my fundamental objective in terms of, I didn't have the money to just continue to go out there and just buy properties at market value, right? There has to be a roadmap to buying something and pulling all of the equity out. And really the only way to do that is to buy a deal at 25, 30% below market value, so that you put your money down and then you get to pull it right back out post-closing and go do it all over again. So I realized that was the only way that I could grow. So I was very intentional about trying to figure out how to do that. So I was actively seeking out all kinds of information around, how do I buy the $500,000 property for $400,000, right? That was very much the only thing I was trying to solve for at the time. So it was just podcasts. It was just, websites like Bigger Pockets. It was, it was just finding blog posts. It was me seeking that education on YouTube videos, YouTube University. I didn't really have a mentor. I didn't really have anybody helping me at the time. It was just me being self-taught and having the time to learn it. The first deal I did was cold emailing a guy who put up a unit for rent. I found a bunch of deals on Craigslist early on. I'd email everybody that put their properties up for rent saying, hey, I'm not looking to rent, but I'd be interested in buying it if you'd be interested in hearing an offer. That was how I did the first one. And then after that, it was just a combination of doing all the other stuff, right? And it wasn't necessarily like I had a great plan. I was just throwing sheer time, energy, and volume of outreach, right?
Yeah.
And at that time, it was much easier to find deals direct to seller than it is now. Not to say you can't do it now, because we've built our whole business on it. But in 16, 17, 18, there was really not a lot of people doing that comparatively to 2024, for example. So it was easy, just email owners. Hey, do you want to sell? And just did that over and over and over again until, next thing you know, you pick your head up and you have a portfolio in front of you.
Yeah, going a mile deep on information. I mean, you learn different tactics and things that work, and then just keep adjusting. What advantages have you found going direct to seller versus out on the MLS or out on the market?
Yeah, I mean, you just buy better deals, right? You're competing with less buyers. And I think that it works specifically, and I think it's important to take a step back too and, again, define what we're pursuing, right? Which is our buy box is 10 to 50 unit multifamily deals in Southern New Hampshire. Those deals typically sell for between $2 and $7 million. So we're not buying large assets, right? We're not buying 100-plus unit, 10 million plus, 50 million plus purchase price assets with on-site management, where we're typically competing against sophisticated players. The owners of those deals list their properties with brokers 99% of the time, right? Those are sophisticated owners that are maximizing profits when they sell.
Yeah.
We're not necessarily pursuing those deals. We're pursuing deals that sit in the middle, right? A little bit too big for the small guys that are local, a little too small for the big, regional, national guys. A lot of those owners, in terms of who we think those owners are, still sophisticated investors, still people that have done well enough in life to put themselves in a position where they own a $3, $4, $5 million asset. However, oftentimes these are long-term owners with motivations that are outside maximizing profitability. Maybe there's partnership dissolution and there's some distress behind the scenes because their partner wants to sell, they don't want to sell. They just, next thing you know, they're just kind of being forced to sell. There's oftentimes management distress. They self-manage and they're going through a few evictions on a 10-unit building, pretty motivated to sell. Oftentimes there's lifestyle motivation. I want to sell and retire and move to Florida. There's all kinds of different motivations that push somebody who owns and operates a property kind of in that space to want to sell without a broker. I mean, we buy so many properties from guys who are in their 60s and 70s that just hate paying brokers. Like, they're so allergic to the idea of having to pay a broker, which, every smart investor knows, like, brokers make their money and they're well worth what you pay them because they're taking it out to all the buyers. But there are a lot of guys who are 70 that think they're way smarter than everybody around them and they just don't want to pay brokers, right? And that's how we end up buying a $2 million property for 175, 17, whatever it is, because they think they're coming out on top because they're saving the 5%. There's all kinds of motivations that are outside of just rational action. So those types of individuals are who we target with our marketing. And fundamentally, our goal is we want to compete with less buyers, right? And the more buyers that are involved in a deal, the harder it is to secure a price that makes you happy as a buyer. So that's the fundamental motivation around doing so, and it takes a lot of time, effort, and energy to build the infrastructure to do that at scale. If you're looking to buy a property or two a year, you can send some direct mail a few times a year. You'll do some deals. You'll grow a business over a long period of time. In our business, we send, tens of thousands of pieces of direct mail on an annual basis. I have a full-time acquisitions guy who's, full 50-hour-a-week gig is just calling owners, calling brokers, calling other industry professionals, really developing our pipeline. And as a result, we can do 15, 20 direct-to-seller deals a year and buy 200, 300 units a year direct-to-seller at these great margins. But it does require a significant time or a significant time investment. And the reality is a lot of owners don't really do that, right? They're just going to wait for investors don't really do that. It's easier to just wait for the broker blast email, show up to the tour, and then put your offer in and hope that, for some reason your offer is accepted or, all the other buyers didn't show up that day type of thing.
And it's not easy getting awarded the property through the broker. I mean, you're selling yourself to the broker because they want certainty of closure. Because if you've got it under contract for 90 days, they need to make sure that you can perform at the end of 90 days as well. So it's and then building out a direct to seller campaign or infrastructure to where you are sending out text messaging blasts and be able to receive those and communicate and the direct marketing postcards or letters. I mean, there's that's a very involved process too, and we've tried that, and it just we were not successful at all. I mean, we spent quite a bit of time, effort, energy, and money on it, and said, "Hey, where are we getting our deals from?" And it was from brokers. So we just we just unwound it and stuck with brokers. And once you build the relationships up, you get off-market deals from the brokers, but you're still competing against other groups. So there's a catch-22.
Yeah, I mean, you hit the nail. Well, I guess let me ask a clarifying question too. What kind of properties, what's your criteria? Who are you mailing to?
Anything like 40 units or more, really 40 to 80 units is what we're looking for.
In what market?
Cincinnati, Dayton, Lexington, Louisville. So we're Midwest.
Yeah, and I mean, you kind of hit it, right? 40 plus, you'll probably have some success, at least some callbacks, right? From folks that own kind of 40 to 60, 40 to 70. Once you cross the on-site management thresholds, there's an entirely different buyer and owner profile, as you know, obviously, right? I mean, and that's a very different game. And the reality is, those deals trade through brokers. I mean, the largest deals we've done have come through brokers. We did a 45 unit last year. It was a $7 million deal. That was a broker deal. Granted, it was a residential agent who was brokering a large commercial deal. She didn't really have any business transacting that type of asset. But again, it's still a good story. I think the other thing too is the competitiveness in your marketplace. Trying to go find deals direct to seller, like where I live personally in Boston, is a totally different ballgame than doing it in a smaller market in Southern New Hampshire with 80,000 people, 50,000 people. I think people oftentimes forget real estate is a competitive business. We can collaborate with other investors and do deals together. And that's a benefit of being, in commercial real estate. But still, fundamentally, there is a finite number of deals that are sold to a finite number of investors. And in different markets, that number is different, and we intentionally select markets. We've done some deals in Florida. We were looking in Tampa, trying to do direct to sell. We were going direct to seller, trying to find deals in Tampa. We just couldn't, we're competing with so many people. Yeah. So we went 40 minutes inland in Florida to a city called Lakeland, which is still a growing market, but it's a smaller city. We did 2 deals direct to seller there, a 16 and a 28, within a 6 month period of time. And then we did a 48 unit 6 months after that, also direct to seller. And the fundamental reason is those people are receiving less outreach. They're receiving less mail. It's a market with fewer transactions. We're competing with less sophisticated folks. So we're very intentional about where we invest, just because we want to align this strategy with a market and a buy box that allows us to have success, right? Which I think is definitely an important part of the process, as you're obviously aware of.
Yeah, tertiary markets are great base hits. I mean, they're steady Betty as far as renters go. There's not a ton of there is competition, but if you just renovate up one level, I mean, you're the best. You're the best spot in town. You can push the rents. So we've got quite a few assets in tertiary markets, outlying areas for a major MSA, but still tertiary. But yeah, no, it's what has been your biggest acquisition to date?
Biggest acquisition, I think, we did a 45 and a 23 in a package deal. That was, I think, between the two, was about a $9 million deal. It's funny. We're 12 months in. We're about to refi. We bought them in the same raise, but basically we're doing individual refis on each property. We're about to refinance a 23 unit, return all the capital that we raised for that specific deal just in a year. We basically paid just over 100 a unit. We're into it for 20, another 5 to 7 with closing costs. So just shy of 130 a unit, and that'll appraise out at 170, 180 a unit. So all kinds of value creation there. The 45 unit, that was same seller, part of the same deal. We've 2x that rent roll in a year. Basically brought average rents from around the 1,100 mark, up over the $1,800 per unit mark. So not quite a 2x, but almost, right? We've basically, we took over with a lot of vacancies, so we have 2x the rent roll from closing. It's very indicative of the deals that we do, where we're buying deals from true like mom and pop operators that are like real value adds. And I think a lot of the deals that are marketed as value adds oftentimes aren't. It's a sophisticated owner who just maybe renewed leases at a 1% increase instead of a 4% increase, right? And there's like some gap there, but it's not anything like extraordinary. A lot of the deals we do, we're typically, rent rolls are increasing 50, 60, 70%, within 6 months, because people are renting units for $1,000 when they should be at least at 1,500, 1,600, without even doing any renovations. And then if we're doing renovations, we're bringing up another, 100, 200 above that. So in the market that we buy in, we find a lot of those really meaty deals. But that was our biggest deal. To the short answer to your question is we closed in July of 23. So we're about a year in. And that deal is going extremely well. But our model is we do high volume of smaller deals. We did so far this year, we've done 12 deals. Average unit count for those deals is, I believe, 8 units or so. So we'll put a handful of deals under contract, 3, 4, 5 deals, and then we'll raise capital in a portfolio structure from investors to buy them all over, a 30, 45 day period of time. So our average raise is usually anywhere from $1.5 million to a couple $1 million, and we'll do 4 or 5 of those a year with these smaller deals.
So are you doing more of a fund structure, or is it a syndication? How's that set up?
Yeah, so we typically just syndicate equity, and we have our deals defined when we're going out there and raising the money. So we've never raised like an open-ended fund where we're raising capital from investors with a buy box, and then we'll go out there and buying deals that fit the description. We probably will do that in the short-term future because it is a much more economical way, and it's an easier way for us to do it from an administrative standpoint, given the fact that we're high volume of these smaller deals. But in the past, we're typically putting deals under contract at a rate fast enough to where we have 3, 4, 5 deals, 6 deals, whatever it is, number of properties. We know we're going to have to raise $1.5 million, couple $1 million to buy those. We've put them under contract over a period of 60 days, and we know they're all going to close within kind of a 60-day window. So we'll go out there and do a 506B or C syndication. We'll raise capital with those deals defined, with the underwriting for those deals communicated to investors, so investors know exactly what they're investing in. And then we raise capital and we use it over the course of a couple months to close those deals. That said, we have raised for like individual deals. We're under contract right now on a 10-unit deal. It's going to be a couple $1 million. Total equity raise for that'll be $800,000 or so, because it's a pretty heavy value add. That deal's like right on the fringe of something that we would just raise for. It's a smaller deal, and it's the PPM costs start to kind of cut into the deal a little bit too significantly for us to maybe do a single asset raise on a deal that small. So up in the air on whether or not we're going to do it with that one, but we'll, if we have another deal under contract, we could just loop it in, right, and get a couple in an entity, and then we'll raise for a handful of deals at a time. So it's a bit of a convoluted process. And I think in the future, we are going to move to a more of an open-ended fund structure where we raise $4, $5, $6 million, call it down over the course of a year, and then we just deploy it. And that way it's a little bit easier for us to manage it from a legal and administrative standpoint.
What kind of returns are your investors expecting? Is there a pref? Is there equity split?
Yeah, so we pretty standard pref with a split. It'll change depending on the deal. Pretty common in that it's, we usually have an 8 or a 9 pref. We take a little bit more of a promote because we don't really charge any fees. So we'll typically do an 8 or a 9 with a 60-40 above it, 60 to the LPs, 40 to the GPs. We charge a 2% acquisition fee, but we don't charge any asset management fees. We don't charge any disposition fees. We don't charge any construction management fees. So incentives are very much aligned. There's no tiered waterfall where if investors hit a certain return, then it, they're started to become more diluted. A lot of investors balk at that because they're used to investing in institutional grade deals with like an 80-20 above a 7 or something like that.
Yeah.
The way we communicate it is, and I think this is a really important note as it relates to small versus large deals. Doing 150 unit deals, turning a cruise ship. And that's an efficient market. You're very rarely buying a deal deep below market value that's of that size, and for all the reasons we've already talked about kind of in this conversation. So a lot of the deals that we're doing, we're de-risking the investment so significantly because we're buying, for example, I'll use the one that we closed a year ago. We're paying $7 million for a property that's appraising at 875, literally as is, with no spend, not an as stabilized appraisal post value add, an as is, as current appraisal with as stabilized being over 10, and we're buying it for 7, and we have a $500,000 reno budget, right? Something very minimal. So because we're buying at such a margin, so much of the returns are coming at the day of closing and not through projected rent growth, not through projected business plan implementation, not through just, what we're hoping the market ends up doing. So we have a lot of investors that really enjoy that. And the fact that we can get in and out of a project in a year, oftentimes less. A 20-unit apartment building, you're done with your business plan in 9 months, 12 months. 150-unit asset, you're not done with your business plan for a couple of years typically, right? It's like turning a big cruise ship instead of a speedboat. So a lot of our deals, we're at capital event, whether that's sale or refi, within 9 to 12 months. I mean, our model is we typically refinance and return a very large percentage of investor capital. So our IRRs look great on paper. And from a projected return standpoint too, we're typically projecting 19-20% plus IRRs, which on a risk adjusted basis, I think people really admire about the deals that we do, in comparison to some of the larger assets, which is just a more efficient market. So that's why we take a bit of a beefier split, as well as the fact that our incentives are very purely aligned and that we're only getting paid through the success of the deal outside of an acquisition fee. And I think that, it makes us stand out a little bit more relative to a larger fee load syndicator who's charging more fees, but a skinnier promote on a larger deal. Yeah,
no, I like it. It's scattered management's a little tougher, but you can find those base hits and they accumulate, and that's what really wins the game: consistency and base hits. For sure. Mm-hmm. If I'm an investor just looking to get into real estate and not really sure which direction, how would you say would be the best direction to pick the path?
That's a great question. I think you got to get clear on your goals first and foremost. People want different things, right? When I started, I wanted to build a portfolio of properties that I personally owned because I didn't want to have to answer to partners. I didn't want to have to answer to investors. I didn't want to have anybody else in my corner other than me. And that was part of it. Was I was a young person who wanted to take a lot of risk, because I was in a position where I could do that, and so for me, that was using a lot of private debt to buy a lot of deals. And really, really, I was living for cheap, right? So my goals were different in that I wanted to very aggressively build a rental portfolio that gave me a base of income that I could rely on into the rest of my life. And I did so extremely aggressively at a time when I was able to do so from a life standpoint. And I didn't really have the objective of raising money at all, and that came later just through wanting something different out of the business. But let's say you're the inverse of that. Let's say you have the desire to go and build a large syndication business. You're a high-income earning W-2 employee who has a bunch of other high-income earning W-2 employees around you. You think you can raise capital you have no interest in being on the finding deals on the operational side, well, your path is going to be very, very different than what mine was. So I think you got to get very clear on your goals. If you are on the, I want to go operate deals, I want to build a portfolio of properties with my money, you got to get good at finding deals. Like that is the one step in the process that completely dictates how quickly you'll grow a portfolio. Like literally, that is the one step in the process. You should be hiring management companies. You should be outsourcing everything as it relates to the operations of your property. You should be spending all of your time finding great deals, because if you can find deals at a discount, you can buy deals at a much higher rate because you're pulling out so much more of your cash in a shorter period of time. Like that's the one thing you should solve for. But if you want to go out there and you want to go buy large assets, you have no interest in buying small deals, you want to buy 100+ unit assets, or you want to raise money, well, the goals are different. You should go find an operator who's extremely good at what they do. You should offer to raise money or bring money to their deals. Get on the GP, start building a track record in that respect, start building relationships with investors. Raise 500 grand for someone who's, raising 5 million for a deal, and just take a small slice of that deal. That's probably the roadmap, So I'm not really giving you, I guess, an exact answer because it's so dependent on what I think your goals are. But you have to very, very narrowly define what you're hoping to achieve, and then back into what you need to achieve in the shorter term in order to build upon that, to make your life a little bit easier, down the road. Which is going to be, I think, a little bit different for everybody. But for me, that was just getting really good at finding deals, because that was the roadmap to quickly building a portfolio. And if I was raising money, it would just be meeting investors, building an email list, building some kind of platform to talk about what we're doing, podcasts, social media, what have you. Find great operators to go raise for, be a great partner to them, and then start slowly and then continue scaling over time.
Yeah. I think the learning lessons you can learn from operating your own properties too along the way is, it just makes you sharper as an operator, as a investor, as just getting the closing experience of how a transaction can go full cycle, to refinance or selling it off, and then managing tenants, keeping the books, maintenance, and on and on and on. There's a lot of lessons that can be learned just on a small level, and then grow from there. And then, of course, what about books? What books would you recommend?
What's funny is I've never really read any real estate books. I think the nuts and bolts of real estate is very straightforward. Like you need a 1-page Excel sheet to analyze pretty much every single deal you look at, in my opinion, right? It's what's your yield on cost versus what's the market cap rate, and now if you have a good deal or not. So I think the finances are pretty straightforward. I think the operations you learn over time. You hire great management professionals to run your assets, and then you can learn from them if you ever want to bring it in-house. A lot of the reading that I did was sales and marketing oriented. The 1-page, I think it's the 1-page marketing plan, was like a book that I read a lot of as it relates to crafting your marketing message to your recipients, which for us were sellers in the beginning, and then that obviously evolved to investors as we started raising capital. That was a really good one for me. The Chris Voss negotiating book, Never Split the Difference, was huge because we were out there like negotiating deals on a week-by-week basis. Really anything to do with sales and marketing. Real estate's a sales and marketing business. If we're just going to cut it, be very straightforward. Real estate's not about real estate, unless you are in the management field, right? And you actually need to understand building systems, local landlord tenant laws, all of that. The vast majority of people listening to this podcast, I think the vast majority of people listening to or who are investing in real estate need to get better at sales and marketing. You have to get better at communicating what your business does, whether that's to sellers and brokers or whether that's to investors if you're raising capital. And for a lot of us, it's both. And being able to consistently deliver that message, consistently tell your story, consistently get in touch with the people that are going to help drive your business forward is where you should be spending your time. So that's a lot of the content that I've consumed over the years is sales books, Never Split the Difference being a negotiating one, but the 1-page marketing plan being a great marketing book. And what's funny is I think, I don't have it. Oh, the Sales Bible by, I think it's Jeff Gitomer. It's like a playbook on how to just be a great salesperson and build a great sales organization, and how to think about building a funnel, which I think is how we need to think about sales. Is we're not trying to close one person. We're trying to build an engine that produces leads, whether that's, properties to buy or investors to invest.
Got it. Very cool. Awesome. Axel, if somebody wants to get a hold of you, learn more about yourself, how can they reach out?
Very active on Instagram at Multifamily Wealth, the Multifamily Wealth Podcast on Spotify and iTunes. And then if you just want to shoot me an email, Axel, AXEL, at aligned, ALIGNEDREP.com. So short for Aligned Real Estate Partners, and alignedrep.com is where you can find our website as well.
Awesome. Definitely appreciate your time today. Look forward to following you, and we will talk soon.